Like you said, my name is Angie Aney, Director of Project Management at WDC. I have the pleasure of introducing Jared. Everyone, thank you again for coming as well. Jared is actually the Chief Economist and CEO at the Dakota Institute. He's a South Dakota native with years of experience in analyzing and communicating about the South Dakota economy. He earned his bachelor's degree at South Dakota State University and his PhD at the University of Nebraska-Lincoln. He began his career teaching economics at Big Ten universities, but returned to South Dakota in 2017 to lead Benchmark Data Labs, an innovative data consulting and outreach organization. Now Jared brings his experience and expertise to the Dakota Institute for Business and Economic Analysis. His research fields include economic impact modeling, economic forecasting, regional labor market assessments, and treatment effect estimation. Thank you so much, Jared, for coming and being here tonight. We really appreciate it. And we always love hearing you talk. So with that, I will let you take it away.
All right. Speaker's prerogative, and move this forward a little bit. Thank you, Angie. Thank you, Chris. Thank you, the community of Watertown, which has invited me back again to talk to this community. So clearly, I'm doing something right, or halfway right. Pleasure to be here. Today, we want to talk a little bit about the business cycle and making sense of it. So I think this time, so we're not doing a PowerPoint, but everybody's got some slides in front of them. They were printed out. So you can sort of follow along with me and kind of as we go through this. I think one thing I want to say at the outset is we're sort of looking at the macroeconomy, we're looking at the business cycle. What we're trying to do, and what I'm really trying to do with you guys, is understand what's coming or taking place starting from the data, right? So we're looking at the data, the sort of facts on the ground, and we're extracting the story, right? We're sort of detectives. We're not necessarily news pundits, right? We are storytellers as economists, myself. We're telling a story. We're trying to make sense of what's going on, but we're starting with the data and ending with the story, not starting with the story and ending with the data, right? I think that's really sort of important to put that out there up front, which is why I can tell you that it's definitely not a typo in the title of this PowerPoint, okay? It is, it's a breadcrumb, it's a metaphor, right? For making sense of what's going on in the economy with imperfect information, with perhaps unreliable information, perhaps with typos. So again, it is definitely not a typo in the title of the presentation. 100% ground being laid before we got started. Okay, so thank you all for that. Kicking off, Dakota Institute, myself, what am I? I'm an economist, I'm an applied research economist, Dakota Institute for Business and Economic Analysis. We're an organization that sort of interfaces with government, with the business community, bringing expertise and analysis to help strategic planning, decision-making, economic development, right? We're trying to help folks better understand the lay of the land, what might be coming, and so they can bring that information and planning into their businesses, into their communities, so that basically we're all making smarter decisions for South Dakota and enabling growth and better outcomes in the future, all right? And that's where we're at. We're based in Sioux Falls. If you have questions about Watertown, about the state of South Dakota, your business, we'd love to talk to you, all right? So feel free to reach out at any time. What we're gonna start with is a couple of sort of headlines. If you go to your sort of first slide, what I've pulled out here, this is a news story from just a week or so ago, maybe a week and a half. Has anybody seen this headline, right? So 22 states in recession or close to it, new analysis finds. So this is, well, one, it's really interesting on a couple of fronts. It's a good place to start, I think, this meeting of ours, this story that I'm trying to tell. the picture that's painted here, it's not entirely clear. There isn't sort of a red state, a blue state. Well, it's sort of blue and we'll call it orange, right? But it's not a political divide here. It's not necessarily the coast versus the interior. But there's definitely something going on across the country right now. Some states expanding, some states sort of in stasis, and some, and South Dakota is included in this, sort of falling behind. And this is something, some of you might have heard me talk earlier this year, and I've been sort of telling this story that South Dakota's been in recession basically for the last 12, maybe as far as 18 months. So this is, to me, this was some sort of like vindication that we were the right color. If South Dakota had been one of the expanding states, I would have been happy for South Dakota, but I would have been a little bit upset for my own personal reputation. But this is kind of where we're starting. We've got some choppy level economic performance at the state level. The country as a whole seems to be doing pretty well, but again, mixed bag. We'll get to that. But the situation we have here is one of sort of uncertainty, right? And it is something that I am definitely a little wary of as we're getting to the end of this year. This government shutdown is not happening or not helping. Renewed tariffs on trade with China. Who knows if those will actually go into place eventually. But then also the expiration of the ACA subsidies. These are all sort of major headwinds. And if you look at some of these states that are doing well right now, they're on that expansion path. Those are ones that are going to potentially be hit really hard at the end of the year with expiration of those expanded or enhanced ACA healthcare subsidies. So some of the states that are leading the charge right now could be, in for more of a headwind in short order. All right, but we're starting from this place of asymmetric growth. Right, some parts of the country doing better than others. Then we're going to go to the next slide. This one just came out, I think, last week, this headline. It's something that's been talked about a little bit, but who has seen this one? This slide or this headline that basically says, all right, the only source of growth in the United States in the first half of the year is AI data centers. Like everything else in the country is sort of flat at best, and a lot of sectors of the economy doing rather poorly, except for this sort of AI data center technology boom. There's certainly, you're hearing a lot about this if you're looking at the stock market. So, the companies that make up the major stock indices, NVIDIA, the FANG stocks driving most of the growth in the stock market. And what we're seeing here with this slide, or what's sort of indicating to us, is that that's happening at the GDP level too. So on the left-hand side is what's the year-over-year kind of growth, quarter-over-quarter, half-over-half growth in this fixed investment sector of the economy. All right, so this is investment by businesses in capital structures, computing equipment, software. All right. So we see this massive growth in the first half of 2025 up to about 30%, all right? The right-hand side is what if we look at real GDP growth and we subtract that out? So this now has, consumer expenditures, it has services, it has all of this kind of stuff, it has exports, imports, it has the farm sector. We just stripped out this fixed investment on technology stuff. And what you see is in basically the first half of 2025, it's basically zero. Now, the real story is a little bit more complicated than this. There's a lot of stuff going on with imports, especially in this sector, that if we fully look at this situation, it wouldn't be quite as bleak. It wouldn't be that AI data center booms are driving all of growth. But it is interesting. And I point this out because we just talked about asymmetric growth on a geographic level. Some parts of the country doing well, some doing better, not so well. Now we're seeing asymmetric growth at sort of the sector level. So some sectors in the economy growing strong, performing well, and other sectors not doing so well, all right? So what we're gonna move into now is some of the data and trying to understand where we're at in the business cycle as a nation. But this is where I wanted us to start, with just a couple of headlines that are saying, ooh, some states not doing so good. some industries maybe not doing so good, all right? So as we sort of kick this thing off, I'm showing you a nice happy bar graph of real GDP growth, all right? So this is GDP growth from the previous quarter at an annualized rate. And just a quick sort of sidebar, make sure everybody understands what that is. You can have a percentage change from the previous quarter, right? If you say percentage change from the previous quarter annualized rate, you're basically saying if the economy grew at that rate for the entire year, what would annual growth be? So if you look at the first quarter where it says negative 0.6%, excuse me, the first quarter of 2025, negative 0.6, that was a down quarter, it wasn't a good one. If the economy performed the same way in Q2, Q3, Q4 as it did in Q1, what would GDP growth for the whole year be? It'd be that negative 0.6, okay? So in Q2, we see 3.8%. That doesn't just mean we reversed course and growth was positive in the second quarter. What it's saying is if growth in Q3 and Q4 were the same as it was in Q2, growth for the year would be 3.8%, okay? So that's just a real quick primer on like how do we interpret that number. It's just a little bit different than what we normally think of in terms of year-over-year growth or quarter-over-quarter growth. But here's what we want to see, all right? The kind of average in this post-COVID era that we've got here, it's probably too short to call it an era, but you know, bear with me. It was about 3%, give or take. So the OECD average is about 1.5 to 2. So the US is performing really well relative to the rest of the world, relative to developed countries. Yeah, was there a question?
Yeah, sorry. On the previous slide, I want to make sure I understand.
Mm-hmm.
So in second quarter of 2025, the annualized quarterly growth rate is 3.8%. So considering previous two quarters were positive 1.9 and negative 0.6, should we interpret that second quarter was so strong it lifted up previous quarters to that level?
Yeah. Yep. So the question was, how do we interpret that second bar in Q2 2025? It's not just that it was a bit of a turnaround, it was a really strong turnaround and kind of reversed what we saw in the first quarter, all right? Okay. So relative to the rest of the sort of developed world, Australia, New Zealand, down there in the Oceania area, most of Europe, you know, we're thinking OECD. US is doing really well. What we do notice though, is if we kind of go back to Q2 2024, we've been on a bit of a slide, all right? It's a downward trajectory going into the tail end of 2024 and then starting into 2025, all right? So that's why that reversal in the beginning of this year, or in the second quarter of this year, was really pronounced, right? There was a lot of conversation about why we were so bad in the first quarter, why the growth number was really bad, and then how it could turn around so strongly. And we can understand this. This is not completely unintelligible to us. If we go to the next slide, we'll see what that story is, or the biggest explanatory factor as to why GDP was not focused on so good in Q2, but so bad in Q1, okay? And what this graph is showing us is line graphs. These lines are showing us is monthly exports and imports. So we get this information from the Census Bureau, basically showing us the value of goods coming into our ports and the value of goods going out of our ports, right? The spread between those two, the top line, the red one is our imports, excuse me, the bottom one, the bluer one, is exports. The spread between those two, we got a word for that, a name for that, it's called the trade deficit, right? So what you can see throughout this entire time period is a consistent trade deficit. I'm not going to argue that that's a bad thing, all right? But I'm pointing out that's what that is. It's the fact that we're bringing in more goods than we are exporting. At the same time, we're exporting more dollars in debt than we are bringing in. So we have a surplus on sort of that side of the balance sheet, all right? Because we're exporting, we're importing more goods, our dollars are leaving the country, foreigners are taking those dollars and then reinvesting them back into the United States. So that helps maintain lower interest rates, it helps maintain supremacy of the dollar. There's a lot of really good things. So I don't want us to just think that trade deficit, bad. Okay, it's much more complex than that. But we see a consistent trade deficit up until about, well, to the far right of that graph. So we get to Q4 2024 and Q1 2025, and we see this massive divergence, right? Where that import line shoots up. That is 100% firms anticipating tariffs, right? So when you see that spike drop back down really pretty sharply, you know, that's kind of March, April 2025, Liberation Day, all right? So this was firms front-loading the tariffs in anticipation of increased tariff activity coming out of Washington. Firms bulked up their inventories. If you were on the manufacturing side, you brought in as much raw materials as you could. If you were on the retail side, you were buying as much stuff from abroad as you could, putting it in warehouses so that you could put it on shelves and you wouldn't have to pay those tariffs, all right? So, and we're just gonna see a reinforcement of that on the next slide. This is taking those same trade numbers and putting them into growth rates, okay? So now the trade deficit is gone. Well, careful the way I say things, I got reporters in the room, okay? The trade deficit isn't gone, but the two lines are right next to each other. And that's basically showing us that imports and exports are growing at roughly the same rate, all right? And how that's evolving over time, market forces, they're relatively balanced in terms of their growth rates, except for that front loading of the tariffs. And we see that sticking out towards the end where imports are growing by 3,000% year over year, all right? So that, in the GDP accounting of things, is a negative to GDP. So imports, goods produced abroad, brought in, that reduces GDP. Exports produced here, sent abroad, that increases GDP. So it's a mathematical relationship. And so you might have seen people talk about this, you might have seen this in the press. Why was GDP so bad in the first quarter? Imports. That is the single largest cause of that negative GDP growth in the first quarter. It wasn't the economy hitting the skids and going crazy. It was not the portents of recession. It was firms maximizing profits. They were importing as much as they could prior to tariffs being imposed, all right? They didn't know what they were gonna be, but they knew they were gonna happen. And so they were hedging that bet and importing as much. So this was import explosion. On the export side of things, or one of the interesting things I want to draw our attention to on the far right-hand side is exports are actually sort of falling as well. Export growth is declining over the last kind of 6 months going in, or of 2025. So there could be a couple of different things here happening. We're not quite sure yet. One of it is certainly going to be the sort of trade bully effect. Countries are retaliating against tariffs. We're seeing that with China refusing to purchase US soybeans. We're seeing that with Canadians refusing to buy American bourbon. So there are negative effects to tariffs. Other countries don't necessarily like it. So our exports are decreasing in some areas. Could be short term. I don't want to sort of say the sky is falling, but it is something we definitely should note, because that is if you're a manufacturer that does exporting, we all, maybe heard about, I'm drawing a blank on the German company that manufactured combines around this part of the country, and they closed up shop, moved their production to Europe so they could sell the combines to Canada. So that kind of stuff does happen. And it can also be, part of that is the US just isn't the only game in town anymore. So there's more competition, there's more other countries that compete against our exports, so supply chains can move for us or against us. And countries can start importing the things they need, they used to get from the United States, from other countries. So those are kind of headwinds on the export front, but we're seeing imports rising again as well. So that last little hook on the import line, we're seeing those growing as well. And again, it's too certain to really know exactly what's happening there, but a large part of that is going to be basically inventories have emptied out. So firms front-loaded on the inventories. They've been emptied. It's been a little while. They're starting to have to bring goods in again, right? You couldn't necessarily re-engineer all of the supply chains, so we're seeing that import activity having to pick up again, all right? The next slide, let's just see it from another way. This is the sort of income statement for the U.S. government. The first time I'll use that phrase for tonight. But this is monthly custom duties. So this is how much money the Treasury is collecting on those tariffs every month. And you see basically a flat line, very low tariff country, relatively low tariff country, up until Liberation Day, and then that shoots up. In the grand scheme of things, this is a very small component of federal revenues, but it's a very stark graph, and it is a very clear reminder that tariffs are taxes, right? They are taxes paid by the importer. Now, some of that is shared between the company you buy stuff from and the purchaser in the United States. You know, the sort of how that tax breaks down, what the incidence is, but that is revenue that's being collected at the border when those goods come across. And so for businesses, this represents margin compression. To the extent that they're not raising prices, it is compressing margins, which puts pressure on their costs and how they maybe think about hiring and firing and all their business activities. It puts pressure on them to identify new supply chains. It puts pressure on them to raise prices. We will talk about prices here and again in a second. And for consumers, it causes an incentive to maybe change the mix of purchases, the types of goods and services, and maybe shifting from one company to another, one retailer to another, or foregoing purchases altogether, right? So this is just a quick explanation of kind of what's happening with GDP and why the first quarter was so negative. The reverse, why was the second quarter so strong? The complete reduction in imports, right? So we had this really strong increase in imports that pulled down GDP. In the very next quarter, imports fell off a cliff relative to the prior quarter, and that helped boost GDP. So you have this sort of seesaw effect. Why was it so negative in the first quarter? Imports. Why was it so positive in the second quarter? Imports, right? On the one hand, imports were increasing. On the second, they were decreasing, right? So that's the big cause of what's happening there. But now I want to shift us a little bit to just checking my time here real quick. Please don't be afraid to throw out the hook if you need to. All right. Now I want to bridge us a little bit to eventually building to the Fed and talking about interest rates, all right? Because if we want to understand what's going on with GDP and the macroeconomy, imports is a big thing for understanding the numbers on the GDP side. Inflation and the job market is a really important thing for understanding the Fed's decision making and what could be happening with interest rates in the future. So we're going to start off with inflation. So on this graph, 3 different lines. I've got the lights are a little low in here. I've used kind of some cooler, darker colors. I don't know if they'll show up the best for you guys, but I have 3 different inflation measures. One is the CPI. That's the Consumer Price Index. That's the headline inflation number. If you look at the mountain that is the inflation bubble, if we'll call it that, in about 2022, the CPI inflation rate is the top line. All right, that's the one that went the highest. The second one we're looking at is the PCE, that's the Personal Consumption Expenditures Index. That is actually the middle line in that mountain. And then the last one is the PCE minus food and energy. And that's the lowest one in that mountain in the middle, all right? Now CPI, everyone's probably pretty familiar with the term. It's a market basket. It's about 30% housing. You've got 20% transportation. Food, I think, is about 13%. Medical is about 8%. That's this basket of goods. And the Bureau of Labor Statistics, when they're not shut down, tracks the cost of these goods and reports their changes as basically changes in this index. PCE, it's used by the Fed. It's a little bit broader. It changes a little bit more over time, that market basket. And it is arguably, especially if you're a central banker, a better measure of inflation, all right? And then PCE minus FE, minus food and energy, is kind of, again, tame it down a little bit. Food prices fluctuate rapidly. You know, everybody remember when eggs were, you know, worth more than gold, all right? When the whole goose laying the golden egg was basically just whoever had an egg in their fridge, all right? Food prices fluctuate a lot, energy prices fluctuate a lot, so they strip that out. And they get this sort of core inflation. And so that's where we kind of see the difference between these three. And what I want us to appreciate here is all three of these lines are relatively aligned prior to the mountain in the middle, all right? The inflation boom that we had in 2021, 22, 23, okay? Then they separate. So during that inflationary period, inflation got really high, got out of control. We started to see this little bit of separation. Then they sort of come back together at the end, okay? What I want us to know or notice, right, is that in the sort of 3 years after this mountain in the middle, the trend, if you will, those three lines are grouped, they're higher than they were beforehand, okay? The next slide, I'll point this out a little bit closer, but just see this mountain, all right, there's a plateau on the right-hand side. We're higher than we were to the left, okay? If you go to the next slide, I point this out a little bit more clearly. It basically outlined the trend, we'll call it the trend inflation rate. It's sort of the average across these three metrics prior to COVID, and that was about 1.7%. So prices going up 1.7% annually, all right, year over year. If you go to the right-hand side of that, now the trend is 2.6%. Okay. Now, just for clarity's sake, this dotted line on the right-hand side, I've drawn it back into kind of 2023 just to accentuate it and help differentiate the two, but it's actually just the trend, if you'll see from the title, from 2024 to present. All right. So essentially, now put your essential banker. You're trying to tame inflation. We went through this inflationary episode, which was the worst inflation we've had since the 70s. Okay. This was not a good time. We are still dealing with the after effects of this, right? And by all three of these measures, it doesn't matter if you're looking at CPI, PCE, or core inflation, PCE minus food and energy, right? Regardless of what metric you want to look at, inflation is stubbornly high, okay? We are a full point, half a point above where the Fed has publicly committed itself to reducing inflation. They have said their goal is 2%. And they've been saying that for years, right? And in an effort to bring this inflation down, try and wring it out of the economy, that's where we've had these elevated interest rates. But it is not working. For whatever reason, this got to be extremely frustrating if you're a Fed central banker. Interest rates have been a little bit elevated. People are upset about that. Is anyone happy with the higher interest rates? Is there any bankers in the room that are even happy? Right? Mortgage rates are higher, everything is higher, you know. There's not a lot of enthusiasm for higher interest rates. President's very unhappy about higher interest rates, okay? But inflation's not coming down. We have been relatively stable at this higher inflationary rate for nearly 2 years at this point, right? So this is just really not good for the Fed. And if we're looking at this to try and understand, well, are we making any progress? The next slide, instead of kind of showing you just year over year inflation, what I'm showing you now on that next one is sort of 3-month rolling average, right? This gives us a little bit more of a short-term directionality insight into what's happening with prices. So we don't want to be fully comparing to a year ago. We just want to compare basically the last quarter, right? And understand, are we moving in the right direction? Maybe it's harder to capture that directional turn if we're comparing to last year. And what we'll notice is it's almost worse if we look at this. So now I've dropped the CPI because if you're the Fed, you're looking at PCE and core inflation, right? So we just have those two. I've focused in a little bit here, and what you're seeing is that plateau is still higher. Not only that, what I really want to draw your attention to is right above the year 2024. and then kind of right above the year 2025. What we've got are these spikes, right? You're the Fed. You have had interest rates elevated for years at this point, and out of nowhere, the end of 2024, inflation spiking again. And then 12 months later, inflation is spiking again. There's no downward trend here. And if you look at it, we seem to be on another uptick, where inflation rates prices are rising again, and so inflation, as measured by these two price indices, seems to be on the uptick again, right? So what are you supposed to do as a central bank? You've only got one tool, right? Central bankers can only do one thing, and that's change the federal funds rate. They can't really do anything other than that. They have no fiscal policy tools or levers. They can't raise taxes. They can't cut taxes. All they can do is try and change interest rates and then hope that that interest rate affects these other interest rates, and that those interest rates affect business decisions and consumer decisions, and that those changing decisions lead to lower prices, right? So that's all they can do. And they've been trying to use this tool for years. It's not working. And when we look at the short-term trends, it's not happening. We're just not seeing the changes that they want in the short run. And so the next one, we're not going to sort of spend much time on this, but the next one does the same thing and gives you this sort of dotted line trend that shows you, even if we look at this 3-month rolling average, it's still 1.7 versus 2.6, all right? So that's Colin Powell losing a lot of sleep. That's a lot of central bankers losing a lot of sleep. Inflation today, that inflation rate, as measured by these price indices, is still 50% higher than it was prior to COVID, all right? The inflation rate, so the growth rate of prices, that when we go into the gas station now, I'm a big fan of iced tea, unsweetened. I'm a northern boy, I'm not from the South, all right? My unsweetened iced tea, and if I'm lucky, it's on sale 2 for $4.50 nowadays. I used to be able to get one for $1, and then it was like $1.50. And now it's like $2 for a thing of iced tea, right? And the margins have got to be great, because I don't think, well, tea maybe is a little higher, but those energy drinks, those inputs can't be going up that much. Okay, so let's move it on a little bit. Now let's get even darker. Okay, so the next one, not consumer prices, producer prices. So now I'm showing you basically a few different sectors of the economy. Again, I apologize for the lights and colors. Maybe I should have used some dashed and dotted lines, but I'm showing you the producer price index for manufacturing, retail, information, so tech, and services, all right? And what we see in a lot of these sectors, if you look to the right of the graph, those producer price indexes, 2.5%, 3.5%, 4%, that's not good, because that's businesses' price inflation, the cost of input goods, the cost of production. If their prices are rising plus 2%, it's hard to see how in the long run we're getting back towards that stable 2% at the consumer level, all right? And you may see retail down there at the bottom, negative 6.8, but that's actually a really bad sign, because when it comes to retail, that PPI essentially measures margins. So what this is showing is margin compression. So at the retail level, companies are getting squeezed. Their margins are shrinking. And if margins are shrinking, that is actually pressure to raise prices in the future. So if you're looking at this situation, you've got tariffs, inventories are being exhausted, it's going to cost you a lot more to import your goods from abroad, and your margins are being compressed. You can't sort of, absorb some of these cost increases. So you really have pressure on basically that price at the retail level, or decisions about letting staff go and things like that. So we're on the price side of the economy, the inflation side of the economy. It's not great right now. Okay, a lot of it's not drastic, right? These aren't dire things, but it's sort of a lot of these things, if we sort of triangulate them, they're not flashing green. If you think back to that first map, 21 states not doing so great. These are signs that are flashing yellowish, all right? We're not saying slam on the brakes, the economy's going off the skids, but from a price perspective, this is a mixed bag. This is not strong performance. Okay, so now let's flip to the labor market, all right? And this is a little bit of a hobby horse here, but what I'm showing you in this graph is basically just job growth, the number of jobs added on a monthly basis. This has been a source of a real pain in Washington, coming out of the White House. There's a lot of anger and upset about jobs numbers not being perhaps what we think they should be. I want to kind of argue, and I'm going to walk you guys through this, that this is a real thing. If you look at this graph, it's a solid downward trend, okay? This is not job losses. This is just slowing in the number of new jobs being created. On the one hand, that's to be expected, excuse me. We came out of the boom of COVID. There's going to be a little bit of a hangover period. Job growth is going to slow down, totally to be expected, nothing to be worried about. Not necessarily the most convenient politically sometimes, but to be expected. What I want to just sort of touch on briefly is how these data are collected. How am I for time? Okay, we're not going to talk about how these data are collected. We're going to move on. What I want to show you now is, if you don't believe the job numbers, okay, believe the income statement, all right? This next one, I threw in a bar graph. We'd had a lot of lines. It was time to put some bars in here with some color. This is basically the income statement. This is U.S. Treasury collections of payroll taxes. So this is our FICA taxes, how much money the Treasury is collecting and how that's growing over time. And the same downward trend, okay? So none of this pollution of surveys of businesses, none of the BLS cooking the books and you can't trust the job numbers. This is the money coming in the door. And the money is not coming in as fast as it was before, okay? So while we saw Treasury collecting more money from the tariffs, on this case, the growth rate, again, it's not shrinking. We're not in the negative territory, but the rate of increase, the rate of growth of collections from payroll taxes is declining. So we know one of two things, or perhaps two things are happening. People are working fewer hours, there's fewer people working, or both, right? That's how this works. Payroll taxes, fixed percentage of that paycheck goes into the Treasury. So we're seeing this slowdown that's happening in the labor markets. So.
Sorry to interrupt you again.
Yeah.
Just looking at the graph.
Mm-hmm.
Nothing is because.
Correct. Well, it could be if that's why I say there's interaction effects. You could have some people working fewer hours, but more people working, right? But the jobs numbers are indicating that there's not necessarily a lot of growth on that front.
Sure. So
Yeah.
there is growth in the revenue.
Mm-hmm. Yes. It is a slowdown in the rate of growth. It's like inflation going from 3% to 2%. Prices are still rising, they're just not rising as fast. So the Treasury's revenues are rising, but they're rising slower today than they were a year ago or the year before that, right? Okay. We have some stuff on inflation rates, or excuse me, on employment rates. I just want to say a real quick thing on this graph. Top line, blue line is headline unemployment. It's unemployment rate. The one under that is the unemployment rate basically for new college grads, okay? What you want to notice is the spread narrowing and the unemployment rate for new college grads rising post-COVID compared to pre-COVID, all right? And if you flip to the next slide, I basically just focus in on the post-COVID period. Basically, this unemployment rate for new college grads is higher than it's been historically by a pretty wide shot, and it's increasing. So our unemployment rate and our unemployment rate for new college grads are both rising, okay? Unemployment rate rising, not losing any sleep over, not worried about that. Don't worry about it. This one for new college grads, that one could be troubling because we're basically entering this period of slowing in the labor market. These people are still graduating, they're still entering the labor market, they need work. So I graduated from college 2007, right into the Great Recession. That was not a great time. That's when you saw enrollments in law schools rising all over the country. Basically, undergrads finishing school, can't find jobs, decide to go to grad school. I waited a year and then went to grad school, right? So this is not a great sign. This is new workers, people with debt, people trying to start careers, their unemployment rate ticking up a little bit. All right, again, it's just a signal, not the sky is falling. Next slide. What we're seeing. This is the ratio of job openings to unemployed workers. And basically what we're seeing is we've dropped below 1. All right, so following COVID, this is especially true in South Dakota. I think in South Dakota it's still greater than 1, but we're getting to this place where there's now more unemployed workers than job openings. And that shows up as we move on to the next slide there into a slowing in the rate of hiring and firing. So this is, you might have heard Jerome Powell, this period of low hire, low fire, right? So businesses are labor hoarding right now. They don't want to let people go at this point, but they're not hiring new workers. So we're seeing this dropping in the separation rate, the number of separations, job quits across the economy, but also in the hires. So this is just a clear sign of saturation, of firms pulling back, of workers not being willing to leave their work, their jobs. And, all right, which one do I want to talk about last? We'll skip to the second to last, the third to last slide, the bar chart one. So what's going to happen with interest rates? All right. What this shows you is a quick overview of where the Federal Market Committee is. So when the Fed governors meet, there's 19 of them. They get together on a quarterly basis. I skipped the first quarter of 2024 2025 because it looked a lot like the second quarter. What this is showing you is basically their predictions for where long run interest rates are. And if you look at the top, on the left you have the doves, right? Inflation, we don't need to worry about them too much. We think long run interest rate, long run federal funds rate is kind of this 2.4, 2.5, pretty low. If you look to the far right, those are the inflation hawks. So those are the Fed governors that are saying, no, we need the long run rate to be higher. We're in this like maybe 3.6 rate. And then in the middle is sort of the consensus, the middle ground. And that's where the majority were, about that 2.9%. You move to June 2025. The doves are still holding strong. The inflation hawks are basically where they were. We're still in the same. This is what's interesting. We go to the last Fed meeting. The doves are becoming more hawkish, right? As Washington is increasingly talking about we need to cut interest rates. We need lower rates, right? Firing Fed governors to try and get votes changed, change the composition of the Fed. Even with all of that pressure from the political side, the governors in some ways are getting a little bit more hawkish. It's hard to know what they think about long run interest rates or long run federal funds rate is going to be, because even as the labor market's showing signs of weakening, inflation is stubbornly high, right? So the Fed's in a bad spot there. Last couple slides I'll lead you to look on your own. That's sort of the South Dakota's in recession and it's not really great right now, but there's better people to listen to about South Dakota. And so I will be ushered off the stage quickly. Thank you.
Does anybody have any questions?
I would love questions, but I kind of want to be respectful to the people that are supposed to come after me.
We can take a couple of questions before we set up for our Q&A. Anybody have any questions about Jared's charts? All right. Thank you, Jared. I appreciate it very much.